Hello, ladies and gentlemen. This is Thomas Fross with Fross and Fross Wealth Management, where, as always, we at least attempt to be the voice of reason in a world full of the pundits of pessimism and that old scary wall of worry. So today is March 16th, means that it's now been 11 trading days since the United States began its bombing campaign against Iran. Which 11 days is significant because we went back to 1973 and we looked at every single major geopolitical event that's occurred. And then we said, okay, we wanted to see three things. How many days did the market sell off on average? What percentage drop did the stock market on average see? And lastly, from the bottom, how many days did it take the market to recover? And interestingly enough, on average, when there's a geopolitical crisis like we're seeing right now, the stock market is historically sold off for 11 days. Once again, today is the 11th day, trading day. On average, the market drops 5.3%. As of market's close today, the stock market's down 2.53% since February 28th. And the last thing, how long does it take for the market to recover from the bottom? On average, 12 days. So 11 trading days plus 12, 23 trading days. We'll call it roughly a month that the market is in this type of a scenario. Now, a question that I often get is, with everything going on in the world, I mean, there's wars, political tension, global conflicts. Why does the stock market not seem to panic more? And the answer is actually quite simple. You see, the stock market is not reacting to today's headlines. It's reacting to future earnings. Investors are constantly asking themselves a major question. Will this event materially change economic growth 5 or even 10 years from now? And most of the time, the answer is no. Now, that doesn't mean that the stock market doesn't react. It usually does at first. As we just said, usually there's about a 5.3% pullback, but the markets recover from those declines within just a few short weeks or months. And the reason is that the global economy is incredibly resilient. Businesses, they adapt. Supply chain shift and economic activity keeps moving forward. So while geopolitical events can definitely cause some short-term volatility, they rarely change the long-term direction of economic growth. Sometimes I explain it this way. The stock market is like a big ocean-bearing vessel going across the Atlantic Ocean. And the headlines, well, they're the waves. Now, some waves are bigger than others, but unless something damages the engine of the ship, it keeps moving forward. And historically, that engine has been economic growth and corporate earnings, which is why staying focused on a long-term plan rather than reacting to every single headline, because there will always be a news headline. If we ever need an excuse not to be invested in the stock market, every day open the newspaper, you're going to find one. But rather than reacting to every headline, that's been the most important discipline for successful investors. I just want to sum it up by saying this. Since 1945, there have been 25 geopolitical crises, more than a dozen wars, multiple recessions. However, if you would have invested $10,000 directly after World War II and you reinvested dividends, that $10,000 today would be worth over $15 million. Now, what's the takeaway? Well, as a client of ours, we've built you a brick portfolio, not a portfolio out of a straw, but a brick portfolio, a diversified, balanced portfolio that's designed for long-term retirement needs, not necessarily for news headlines. Ladies and gentlemen, have a wonderful day.